Welcome to the Deep Dive. This is Talk Tickers, and today we are really getting into the weeds on the Q2 2025 earnings call for Rapid7. That's ticker R7.
Right. The call happened after market closed back on August 7th.
And our mission today is pretty clear.
Yeah.
We need to unpack this strange situation, a paradox, really.
Exactly. Rapid7 delivered, really clean beats on profitability, on cash flow, solid number.
Then the next day, the stock just got hammered.
Yeah. Volume was way up, nearly double the average, and the price dropped sharply.
So we need to figure out why. Why did the market basically ignore the good results right in front of them and focus so heavily on the more cautious outlook?
Let's dig in. Okay, so the results, snapshot, the beat, and then, the backlash.
Right. Let's start with the wins, because they were there. Non-GAAP EPS, that came in at 58 cents.
Which was, way above estimates. Consensus was around, 44 cents, 45.
Yeah, a significant beat on the bottom line. Shows good cost control.
And revenue. It also beat, though maybe not quite as dramatically, $214.2 million. Just about 1% over consensus.
Still a beat. And the margins look decent, too.
Very decent. Non-GAAP gross margin held at 74%. And maybe the most important part for, a nervous market, free cash flow.
FCF, yeah. How's that?
Robust. They pulled in $42 million in free cash flow for the quarter. So if you're just looking at efficiency, profitability, cash generation, Q2 looks pretty good.
Okay, but there's always a but, isn't there? The growth picture. That seems to be where the story darkens.
That's the shadow, absolutely. Profitability was great, but the growth engine itself seems to be sputtering a bit.
How much sputtering are we talking?
Well, total revenue growth and annual recurring revenue growth, AR, both came in at only 3% year over year, just 3%.
Ouch. Okay. So where does ARR stand now?
It's at $841 million total ARR. They have 11,643 customers, which puts the average ARR per customer at around $72,200.
Right. So that 3% growth, that's the friction point, isn't it? Even with good profits.
It's exactly the friction point. You've got this strong cash flow, these bottom line beats, which usually makes a stock look, solid, maybe like a value play.
But R7 is in cybersecurity.
Precisely. And in cyber, investors want growth. They punish anything that looks like slow growth pretty aggressively.
You just have to look at the sector ETFs, right? Like HEC.
Yeah, HECK is up, roughly 25% over the past year. Meanwhile, R7's stock is down significantly, like over 40%, a huge divergence.
So the market isn't asking if R7 is making money. It's asking, where's the growth? And 3% isn't cutting it.
Not even close. And that context, that pressure, really explains why the CEO on the call spent so much time talking about strategy.
The command platform, right? Their integrated AI-driven platform.
Yeah.
That's the path forward, they hope.
That's the narrative. It has to be the path to re-accelerating growth.
So inside that strategy, what's actually working right now? What's driving even that 3%?
Well, the core engine, the bit that's still showing decent life, is managed detection and response, MDR.
Okay.
Management highlighted that. MDR is now over half of their total ARR. And importantly, it is still growing at a mid-teens rate year over year.
So mid-teens, that's respectable. That's the bright spot in the growth story.
It is. It's their proven engine, providing, some momentum.
And how are they positioning their MDR? Is it just another service?
They're really trying to differentiate. They emphasize their years of experience running their own security operations center, their own SOC.
Okay, the operational expertise.
Right. And they combine that with proprietary AI agents. These aren't off-the-shelf AI. They're built on R7's own live playbooks, their own data.
So they're selling expertise enhanced by their own AI, not just software features.
That's the pitch. And it seems to be resonating, at least on bigger deals.
Bigger deals. Tell me about those.
Yeah, they reported winning some, quote, meaningful consolidation opportunities at higher ASPs, average selling prices.
Consolidation, so companies ripping out multiple vendors and going all in with Rapid7.
Exactly. These are big, complex deals, often multi-year, seven-figure commitments. They even gave an example.
Well, yeah.
A big UK retailer. Apparently, they had a really fragmented security setup, lots of different tools. They decided to consolidate basically everything onto Rapid7's command platform.
Wow. Okay, winning a huge deal like that, a full consolidation, that sounds fantastic.
Yeah.
That must validate the platform strategy.
It absolutely validates the strategy, no question.
What's the flip side? If they're winning these massive deals, why only 3% ARR growth? Why didn't that move the needle more this quarter?
That's the critical trade-off they had to talk about. Yes, the big wins are great validation. But management confirmed the sales cycles for these huge deals, They're still really extended.
Meaning they take a long time to close.
A long time. Think about it. A major company deciding to overhaul their entire security infrastructure with one vendor. That decision goes through layers and layers of scrutiny, budget approvals, technical reviews.
It's not a quick purchase.
Definitely not. So this longer, higher scrutiny sales process for the big platform deals, that's precisely why management is being cautious about near-term growth and guidance.
Yeah.
The pipeline conversion takes time.
Okay, that makes sense. And this caution, it probably ties into their recent product news too, right? Things that are strategic but maybe don't pay off immediately.
Exactly, like the launch of Incident Command.
Incident Command, what is that exactly?
It's their new AI-native SIEM, security information and event management.
SIEM. That's like the central dashboard for security alerts, right? Collecting logs, detecting threats.
Pretty much, yeah. It's a core piece of security operations. Launching an AI-native version is a big technical step. It helps them deliver that truly integrated command platform vision, connecting vulnerability management with actual threat detection and response.
Crucial for the long-term vision, then.
Absolutely critical. But displacing existing SIEM vendors, that takes time. It's a sticky market. So, again, great strategic move, not much immediate revenue impact.
And there was another piece of news on market access, something about the government.
FedRAMP. Right. They achieved FedRAMP authorization for their InsightGovCloud offering.
And FedRAMP, for anyone listening who doesn't know, that's the security standard needed to sell cloud services to the U.S. federal government. Big market.
Huge market. Getting FedRAMP authorization is tough, a high barrier to entry. It signals credibility, security posture.
Long-term potential, definitely.
But again, the federal sales cycle is notoriously long. Management was upfront about it. This opens a massive door, but they don't expect significant financial impact until 2026, realistically.
So another great strategic checkbox ticked, but zero help for the 3% growth problem today.
You got it. It's all about the timing mismatch.
Okay, and alongside all this product and market stuff, there were some big leadership changes announced too.
Yeah, two key ones. First, the CFO, Tim Adams, announced he plans to retire.
Okay. Is he leaving immediately?
No, he's staying on while they search for a successor to ensure a smooth transition. But, a planned CFO change, especially during a tricky period like this, it always adds a bit of uncertainty for investors.
Sure. And the second change?
This one seems more directly aimed at the growth problem. They appointed a new chief commercial officer, a CCO, Alan Peters.
Chief Commercial Officer. So head of sales and go-to-market.
Exactly. And his job seems crystal clear. Fix the go-to-market engine, get revenue growth moving faster, get it to match the product capabilities they've been building.
So what specifically does the new CCO need to fix? Is it just about closing those big deals faster?
It's partly that, but it sounds like the bigger issue is the expansion motion. Getting existing customers to buy more, to upgrade.
Ah, the upsell.
Right. Particularly for the exposure command upgrade path. Ideally, that should be lots of smaller, quicker, maybe lower dollar deals. Predictable expansion revenue?
But that's not what's happening.
Apparently not. Management basically admitted that Path is mostly yielding those same big, long cycle strategic deals right now, not the high volume, easier wins they need.
So Peters needs to fix the pricing, the packaging, maybe the sales incentives.
Yeah.
Make it easier for customers to just add modules or upgrade incrementally.
That seems to be the mandate. Build rigor into that continuous expansion process so they're not so reliant on landing a few massive deals each quarter. They need both.
Okay. And this whole commercial challenge, the slow deal cycles, the need for better expansion, this leads us right back to the guidance, doesn't it? The thing that really spooked investors.
Undeniably. That was the flashpoint for the sell-off after the call. The number one issue was the full-year ARR guidance.
They narrate the range, right?
They narrowed it to $850 million to $865 million.
But crucially, they didn't just narrow it, they brought the top end down.
Exactly. The previous range went up to $880 million. Lowering that high end, well, it sends a pretty unambiguous signal.
It signals management isn't confident about hitting the higher targets anymore, likely because of those deal cycle issues we talked about.
Precisely. In this macro environment, with those longer cycles, they felt the need to temper expectations. That spooked the market.
And the Q3 guide wasn't exactly thrilling either.
No, pretty modest. Revenue guided to $215 million to $217 million. Non-GAAP operating income between $29 million and $31 million.
And they had to emphasize the back-end loading again.
Yeah, they reiterated that net new ARR is heavily weighted to Q4. Now, Q4 is often seasonally strong, but relying on a huge final push.
Especially when pipeline conversion is already slow.
It just makes investors nervous, requires flawless execution in the back half, with macro uncertainty still lingering.
But there was one thing they held firm on in the guidance.
Profitability, yes. Full-year free cash flow guidance was maintained, still expecting $125 million to $135 million for the year.
That's a strong FCF number. So that's the message. Discipline remains.
Right.
Even while they invest in things like that new innovation center in India.
Absolutely. They're saying, look, growth is slower than we want, but we are managing the business for profitability and cash flow.
And that reiterated FCF guidance, that's really key to the whole investment story here, isn't it?
It is, because connecting back to the sector view, R7 is getting treated like a value stock rewarded for FCF, but it lives in a growth neighborhood.
Where that 3% growth gets you penalized heavily, the 40% plus stock decline versus the sector ETF really tells that story.
It does. And this whole situation, the slow growth, the stock lagging, the focus on profitability, it all happens under an interesting spotlight.
You mean the activist involvement?
Exactly. Don't forget, Rapid7 settled with JANA Partners back in March, added 3 JANA-backed directors to the board.
Right. So there's activist pressure here, too.
Relentless pressure. JANA Partners isn't known for sitting quietly. Management is on the clock. They need to either fix the growth, optimize the portfolio somehow, or potentially face more drastic strategic actions.
So for you, the listener, watching this play out, the key near-term signal is all about that new CCO, Alan Peters.
It really comes down to commercial execution. Can he fix the pricing and packaging? Can he get that expansion revenue flowing the smaller, easier upgrades? Or are they stuck relying only on those big, slow-moving consolidation deals?
That's the gap they need to close, and fast.
And this whole mix, the solid FCF, the beaten-down valuation, the leadership changes, the activist pressure, it sets up an interesting scenario.
Which brings us nicely to our segment. This is not financial advice. Remember, this is just a thought experiment, exploring possibilities based on what we've discussed.
Okay, so the setup. R7 is fundamentally sound in many ways, right? Strong, reiterated FCF. A solid growth engine, even if just mid-teens within MDR. A potentially leading AI platform.
But it's trading at a huge discount compared to its high-flying cyber peers, purely because of that top-line growth number.
And you add in the catalysts, the CFO search, the new CCO mandate, the JANA Partners directors pushing for value. The company looks ripe for something to happen. That FCF provides a kind of safety net, a valuation floor.
So what's the outrageous but plausible trade idea this week?
Given this divergence, how about this? A pair trade. Go long Rapid7 and simultaneously short a basket of those high multiple, maybe less profitable, high growth cybersecurity peers. Or just short the HACK ETF itself.
Okay, explain the thesis there.
The thesis is, R7's downside feels somewhat limited by that strong FCF and current low valuation. Meanwhile, any positive catalyst could cause a significant re-rating upwards.
What kind of catalyst?
Maybe the new CCO actually succeeds quickly, and ARR starts to reaccelerate sooner than expected. Maybe FedRAMP starts contributing a bit earlier in 2026. Or maybe the activist pressure forces some kind of strategic move, asset sales, or even an outright acquisition bid.
So you're betting that R7's potential upside from a catalyst is much greater than its remaining downside, especially relative to the broader, maybe overvalued cyber sector.
That's the idea. Betting on catalyst convergence. It's basically looking for a value opportunity hiding within a growth sector triggered by all this pressure.
A classic special situation setup. Okay, it makes sense as a thought experiment.
But remember, seriously, this is not financial advice, just an idea based on the call. Do your own research, understand the risks, make your own decisions.
Absolutely. Okay, let's wrap this up. To recap the core tension here, Rapid7 executed well on profitability in Q2. They reinforced their strategic platform vision with things like the AI-native SIEM, and MDR is still growing okay.
But none of that mattered to the market in the short term. Investor anxiety about the slow 3% overall growth, and crucially, that lowered full-year ARR guidance just completely overshadowed the wins.
So the provocative thought for you, the listener, to mull over is this. It's not really about whether Rapid7's command platform is technically good. It probably is.
The real question is, can the new chief commercial officer fix the go-to-market fast enough? Can they translate that technical lead into predictable, accelerating revenue growth before the market? And maybe the activists run out of patience with this slow growth tempo.
That's the race they're running.
It absolutely is.
Okay, that concludes our deep dive into the Rapid7 Q2 2025 earnings call. Thanks for tuning in to Talk Tickers.